Good morning, everyone. It is a pleasure to start the seventh and last webinar on Real Digital. The goal of the series is to debate along with the society the general guidelines of a future digital currency for Brazil, in addition to talk about cases of use that can take benefit of the issuing of a digital Real Digital and the most adequate technologies for its implementation. In the seventh meeting, the technological alternatives aiming at assessing the integrity with the existing system and the possibility of its integration to international payment systems, and also its security and resilience to the cyber side. For the roundtable today, our speakers are foreigners. Therefore, the event will be in English with simultaneous interpretation into Portuguese. Those who wish to watch in the original language, we have the link in the video down below. For those who want to send questions, you can send to the email real.digital@bcb.gov.br. Bom dia e bem-vindos ao sétimo
Brazilian digital real to discuss the technologies supporting of CBDCs and its interoperability aspects. My name is Aristides Cavalcante, Deputy Head of IT Department of Central Bank of Brazil, and it will be an honor to moderate this engagement. Along with the webinars, we have identified many potential benefits of a widely accessible CBDC to foster innovation. However, it brings important questions. Is there a technology mature enough to deliver the identified benefits with high levels of security, privacy, scalability, and interoperability required for any critical retail payment system? Is it possible to use other technology besides distributed ledger technology to deliver smart payments? If possible, what are the trade-offs? To help us to answer these questions, we invited our distinguished panelists. Our first panelist is Matthew St. Oliver, Senior Product Manager at Consensus. Matthew has been leading Consensus work on CBDC globally as subject matter expert since early 2020, and he's now in charge of Consensus offering for digital currencies. Prior to joining Consensus 3 years ago, Matthew was a consultant at the Boston Consulting Group. Please, Matthew, your initial considerations.
Hello, thanks a lot for.
Obrigado.
So today, most central banks are considering issuing CBDC on a permissioned blockchain network or not on a blockchain at all. And so as an introduction, I just wanted to share a few thoughts about public and permissionless networks and how people's minds are changing about this and why it should matter for the central banks. So over the last few years, most regulated financial institutions were having this trade-off, yes to blockchain, no to crypto. And so they started to build permission networks for multiple use cases, such as supply chain, trade finance, and others. But actually, it's difficult to create network effect from scratch. So our conviction at Consensus is that blockchain benefits come because it is highly open by design and becomes as such a public good. And it allows us to reimagine how we think about digital ownership. As a consequence, we actually observe today a convergence between the crypto world and the existing economic world, with more and more financial institutions embracing those public and permissionless networks. For example, we see payment gateways like PayPal, Revolut, Square, who provide access to crypto to their customer, and they have a business case for it. It increases user engagement and it generates revenue. Similarly, we see payment processors such as Visa, who enables crypto owners to pay at merchants using their crypto with existing user experience and cards. And so even Société Générale, one of the largest French banks, is working with a decentralized stablecoin protocol to collateralize this stablecoin with real-world assets, such as real estate loans. And so with those public and permissionless networks, we reimagine value. And so my recommendation to central banks is to not ignore public and permissionless networks. Obviously, today, those networks have drawbacks, which make it complex for central banks. It includes transaction throughput, transaction fee, environmental impact. But issuing a CBDC will take years. And in the meantime, during those years for the central bank to design the CBDC, the technology will evolve a lot. And so much will already happen. So my recommendation for central banks is look closely at what is happening on those public and permissionless networks, learn from all those experimentation, and work with the private sector to try to address the issues instead of disregarding them.
Thank you, Matthew. The second speaker invited to our roundtable is Ricardo Correa. He is the global head of digital currencies at R3, with a focus on CBDC and stablecoins. He and his team managing a digital currency work group and sandbox with from across both the public and private sectors. He initially served as head of the APAC at R3 and then spent 3 years as global head of partnerships, building a network of more than 300 partners who develop solutions and offer services on Corda. Prior to joining R3, Ricardo worked with the Commonwealth Bank of Australia, Accenture, and Evident in senior technology and leadership positions. He has co-founded 2 high-tech startups and spent the last 20 years working on early stage emerging technology. Please, Ricardo, your initial thoughts.
Thank you very much, Aristides, for having me on the panel. So, in terms of the work that we've been doing, first of all, Matthew presents an interesting opportunity on the public side, public permissioned. And we don't discount those things. The work that we've been doing at R3 over the last 2 years, focused in digital currencies, has brought together a working group of 140 organizations across the world from both the public and private sector. And our strong belief is that this will happen with very strong collaboration between both public and private. Our thesis starts right at the beginning, where money is issued, obviously, by a central bank. And there's a bunch of things today that we know that we have to support in terms of sovereignty and control of monetary policy. And so our thesis suggests that whilst we can obviously see the emergence of crypto, public and permissioned, and the demand for cryptocurrencies and others, we strongly believe that there's a good opportunity for us to bring both private permissioned and public permissioned, non-permissioned chains together in the flow of money. So the work that we've been doing across the world with several central banks, including the likes of Project Jura, Project Dunbar, etc., are looking at not only the interoperability of digital currencies across central banks, but also the interoperability of regulated digital currencies and public cryptocurrencies. So we strongly believe that there's, again, a place for both. And over the next couple of years, the work that we'll be doing in interoperability will hopefully bring together these 2 different opportunities. So again, thank you very much for the opportunity, and I'm looking forward to the discussion.
Thank you, Ricardo. Unfortunately, our third speaker, Wolfram Sigman, had problems with connections. Of course, we continue this panel and he can resolve these problems and we join to us. So I will start this debating, of course, asking to Matthew, and of course, Ricardo, you feel free to make comments too. One of the main drivers for the Brazilian CBDC is to foster innovation on payment service. In our understanding, this requirement translates to support programmable money using smart contracts or similar technology, usually available on distributed ledger platforms. It's a question for central banks because we are in sometimes doubts about using or not distributed ledger technology or centralized technology. So my question is it possible to implement programmable money using centralized technology? Matthew, I don't know if you'd like to start.
Yeah, I can start. So I think it depends on what we mean by programmability. For example, it's possible to work with a bank to configure regular payments to any recipient. So to some extent, this is a programmability where we program that the payments will happen, let's say, every month to this recipient. I think when we talk about programmability in blockchain, it goes a bit further, in that those rules are encoded into an application that is not necessarily controlled by anyone, or was created by someone and then released and then lives somehow by itself. So, for example, it enables the definition of rules on how the money can be used or spent. It can also interact with other applications. And here, central banks have been experimenting settlement of financial assets for a number of years by defining rules of settlement in the financial assets and rules of settlement in the money assets. And those two assets can directly speak machine to machine, somehow machine to machine together to implement the settlement rules that were previously designed. And then we add another layer of this, which is what we called composability, which allows other applications to directly communicate with the money assets. So here the smart contract, to add additional rules on top of the ones that were initially encoded into the money asset itself. So the short answer is yes, it's already possible to do programmable payments today. The longer answer is blockchain and smart contracts enable new business model and new applications that were not possible before.
Thank you, Matthew. Ricardo, like to comment?
Yeah, I suppose my view is somewhat similar in that, we arguably have programmability of money and applications today. I think the key difference that we see is that oftentimes those rules are encoded at each individual organization and replicated. And so you have a lot of reconciliation that's required in order to ascertain that the rules on either side are being maintained and are the same as when we first defined them and agreed to them. And so reconciliation cost, of course, is the massive opportunity that we can reduce by encoding the actual rules in the network and on the asset itself, so that it lives once and is executed across any node in the network. So yes, we can do it today. We do it today. We do it by virtue of rules that are kind of encoded at each individual organization. There's a tremendous opportunity to encode it once, but also to Matthew's point, I think the other opportunity is this notion of composability, where a central bank could provide a set of rules on a digital asset being the very thin OS, if you like, an operating system on top of that money, and then additional participants, be it commercial banks, payment service providers, could then compose additional services and rules on top of that. So that's the opportunity that we see: cost efficiencies, reduction of reconciliation, and more control, and the subsuming of things like monetary policy and so on into smart contracts, allowing them to kind of execute autonomously.
Thank you, Ricardo. I'd like to do this one to you. Based on the most recent literature, CBDC must be a direct liability to central bank. Consequently, the financial regulator has the final word on its issuance and ownership. In this scenario, what would the advantages and drawbacks be to use a distributed ledger technology when this usually requires some level of consensus between participants or consensus nodes? In other words, when the regulator has the ownership and, of course, is the main part of the governance, what are the advantages and drawbacks to use the idea that is a decentralized technology and the consensus requires a vote of many participants?
So, no, please go ahead.
Go ahead. No, go ahead, Matthew. You start.
So I think there's some misconception about when we discuss decentralization and what it matters. Having a centralized authority in charge of managing the governance of this asset is not an issue. And we can take a very concrete example today with a stablecoin called USDC, which is, let's say, centralized because there is only one private company called Circle who has the ability to manage a supply, create new stablecoin or delete those stablecoins. And it's very successful. In the last 12 months, the market cap of this stablecoin has grown from $2 billion to more than $40 billion. And similarly, the adoption is growing by more and more users custoding on their wallets, plus 30% over the last 3 months. And why is it successful? Because even if the governance is centralized, the infrastructure that it uses is this public and permissionless network, which is decentralized. And what's interesting is that when we look at how it is used, it really solves user needs for multiple reasons. One is that it is used, half of the supply is used in decentralized finance smart contracts. So it is used for lending, for borrowing, for margin trading. So basically powering this new form of financial infrastructure. It is also used for crypto investors to hedge their position with a non-volatile asset without spending time and fees to go back into the legacy financial system. And some companies are even using it for payments. For example, when banks are closed during weekends or holidays, they are still able to do real-time payments using those stablecoins. And so my point is, it's not about who is the issuer. Is it decentralized? Is it centralized? That doesn't matter really much. What matters is what infrastructure do we use and how does it enable new application and new business model that were not possible before. We mentioned before programmability, we mentioned before composability, and I think we forgot to mention maybe one of the more important also is real-time or almost real-time settlements, which is also not possible in every country today.
Just to extend on that, I think certainly the experience we have with some of these projects suggests that governance of the asset still remains with the appropriate authorities. The difference is that the actual mechanics to execute that is very different, and becomes a lot more flexible in a sense that again you're able to compose these rules and participate in consensus in a much easier way than we do today. So for us, I think the governance, the rule books that are required are still part of the project and deployment experience, but the actual execution ability is very different. and also the ability to report against these things and to look at predictive kind of views is very different than what we have today. So I think, again, the technology gives us net new capabilities that we don't have today, and it's not necessarily that's required for every single sovereign state. So really looking at what are the requirements, what are the needs, and does this new technology and the new aspects of this new technology kind of solve for the goals and the requirements of each individual country. So yeah, I'll stop there. Thank you, Aristides.
Well, thank you, Ricardo. So I'd like to invite Ricardo for answering this question, of course, based on Corda and our free experience on EIS innovation hubs and projects, as you said, Jura, and of course in Central Bank community. Interoperability between different CBDCs is a requirement to tackle the cross-border complexity and cost problem. What would be your suggestion for the first movers to assure compatibility with future CBDC implementations? How we can guarantee this to make this cross-border payment to follow a minimum common standards to make possible, feasible, that we have in the next future, these cross-border payments to exchange different CBDCs?
Yeah, it's a great question. And I think we've all been tackling that over the last several years. We've seen many different interoperability opportunities. And I think it's important to bifurcate interoperability and integration. For us, certainly, we look at interoperability as the interoperability of multi-ledgers. So Corda to Ethereum, for example, versus the integration of Corda to existing infrastructure, say an Oracle or SQL database. So firstly, you bifurcate those things. And then when you look at interoperability of chains, there's many different opportunities there. We've seen interoperability bridges being developed successfully over the last several years. But we're also starting to see interoperability at the protocol level. And so the 2021 annual report by the BIS, Chapter 3, presents 3 interesting models for the multiple CBDC arrangements or the interoperability of multiple CBDCs. Those 3 models are being tested in various forms. Of course, the BIS has a number of projects that are and initiatives that are testing these things too, in particular the MCBDC project with 4 central banks. That is being looked at, and the other is Project Dunbar, which now I believe has up to 7 central banks looking at the various different models. Project Dunbar today is looking at Model 3 that was presented. And Model 3 suggests that there is, one network with multiple subnetworks within it, and cross-atomic swaps and interoperability is supported. Now, when you have one network, obviously you have shared services that makes it easier to interoperate. So for example, we have the same identity schemes, we have the same rule books, we have the same governance models. And so interoperability becomes somewhat easier in that sense, albeit that still you're trying to ensure that there is sovereign control of each subnetwork. So that's really important to understand. But interoperability, where you're talking about cross-ledger, becomes a little bit more complex. So there are interoperability bridges, and Matthew, I'm sure, can talk to some of the ones that he's aware of and been involved in. And that works fine. My personal view is that the interop bridges are tackling interoperability at the data level, which is a slightly higher level than the protocol. So my sense is that once we can tackle interoperability at the protocol level, that's when we truly unlock the ability to have assets moving freely and seamlessly across various boundaries and networks. And that requires protocol interop. So we've been working on that for several years at R3. Our protocol is called Proof of Action. There's more work to be done there, of course, and there's work generally being done. But my suggestion would be, if anyone is looking at this, and central banks are looking at this, of course, stay close to these projects and these initiatives, understand how these models are being looked at and what's being rolled out, Project Dunbar is really exciting. Certainly, that's one of the key projects that we are working on. It'll have multiple phases. It'll be a multi-year rollout. So these things are not going to happen quickly. So my suggestion is keep abreast of these things. Do your research on the different various bridges that are out there, the protocol interop that's emerging as well. And then talk to the experts. So Matthew at Consensus and others, of course, R3, and of course there's many others that are kind of looking at this as well. But not an easy space to tackle, but certainly there's a lot of emerging research that'll guide you.
Matthew, would like to go?
Yeah, generally, I totally agree with what Ricardo just said. I think just to add on top, so if I set aside the interoperability, I mean, there's multiple parts in interoperability, but of course, CBDC needs to have some form of interoperability with existing systems. That's key, and that already works. Again, Visa already enables you to pay at merchants who do not accept stablecoin as means of payment while using your crypto wallet. One thing that is interesting also for the central banks, I think, to look at is what is happening in the public and permissionless networks, because it's been going on for years. I mean, there's been a bridge, an interoperability between the Bitcoin network and the Ethereum network, something like 5 or 6 years ago, and it's working. Not necessarily that central bank should issue there or create the same bridge, but this technology works. I think maybe to summarize the options, there's probably 3 major options to facilitate interoperability at the protocol level. One is let's everyone use the same network. It's very unlikely because every central bank will want their own level of controls and governance, etc. And so I think what Ricardo mentioned, which is multiple chains that can talk to each other, maybe through one chain or directly to each other, is the right approach. Here, if the CBDC networks use the same core technology that we call on Ethereum networks, like the Ethereum virtual machine, it made things easier. And as such, it's already possible to send assets on public networks from the Ethereum mainnet to layer 2 solutions like Polygon or Binance Smart Chain, which use the same core technology, even if they are different networks. But it's also possible, which is a third option, to have every central bank use their own protocol and then find ways to create bridges and communication between those protocols. It's also totally an option. And I think the work that the BIS is currently conducting, working with multiple central banks, working on those cross-border payment networks and experimenting, doing it for real, makes a lot of sense and will be a key driver to enable this in the future.
Thank you, Matthew. Very interesting points about what happened in public networks. And I'm from Tech IT, of course, and I have a question about that. Public blockchains are usually based on high data transparency, and that transparency is being used to allow this interoperability via cross-chain swaps, for example. How free speak? It is implemented by monitoring assets in one DLT to represent it in another DLT. The matter is that when you go into regulated space, bank secrecy and commercial secrecy must hold. So I guess the question is how to achieve interoperability across different chains without relying on so much transparency. How to keep the bank secrecy and commercial secrecy in the DLT environment we have a high level of transparency. I don't know if Matthew or Ricardo would like to start this question.
Yeah, I'm happy to give it a go. I think you talked about public chains. Certainly, our work mainly is on the private permission side, but certainly in terms of ensuring that we maintain privacy, on the permission side, and certainly on Corda. Corda is a peer-to-peer network that only shares need-to-know data with need-to-know nodes. And so, by its very design, it's already constraining what's visible across different participants. As you go across chain, the protocol that I mentioned, proof of action, further controls what's visible across various participants and across networks and borders. There are other technologies, of course, that are emerging that would further secure the privacy of data. We've heard, and I know that we'll talk a little bit about zero-knowledge proofs and other technologies such as secure enclaving, which the likes of SGX provide from Intel. So here, you could actually secure your data in an enclave and have it completely secured from the various participants. It does require a slightly different architecture, and it requires some thoughtful design. But today, I feel that, certainly on the private permission side, that there is a lot of opportunity to secure data across participants, across chains, across networks. But I'd be interested to understand from Matthew what his perspective is on the public side. So slightly different, I suspect. Over to you, Matthew. Thank you.
And so I think it depends. It needs the discussion needs to probably get one step further into what is the level of privacy, what information needs to remain private. Basically, today, at the core with blockchain, what is visible is an address, which is kind of similar to an IBAN, and an amount of tokens, which are moving. Is this information already too exposed? It does not provide any information on the user real identity. Obviously, no user identity should ever be stored on a blockchain. But even if this level of information is too much, there are ways to solve it. One approach is to restrict who has access to read the core ledger. And that's what one of the solutions with permission networks. With Corda, it's also possible with Ethereum. It's restricting the access to the ledger, let's say to the central bank and to the bank. Maybe this is not enough because it means that even one bank can see what the other bank is doing in terms of activity. So the question is, what level of granularity do we want to have on the blockchain? Do we want to have individual citizens' wallets directly, the holdings of citizens directly written in the blockchain? Is it which is a model of most public blockchain today? Or do we want the banks to be the custodians of the CBDC for the end users? In such case, on the blockchain, we will have only the information of the bank holdings, which is basically what we see on the RTGS systems today. Both can work, but yeah, I guess it's really a question of what are the requirements from the banks. Today on public blockchains, you have the two models. You have, as Mathieu Saint-Olive, I can have my own wallet on the blockchain, or I can rely on the custodian or crypto exchange like Coinbase to custody my private keys on my behalf and manage my assets on my behalf. And in such case, you will not have access to my holdings and my activity. You will only have access to the consolidated activity of Coinbase. And so if there is a cross-chain transfer, if I initiate a cross-chain transfer using my Coinbase wallet, you will not see my specific transaction. You will only see the consolidated transaction of Coinbase. Is it too much information for the central banks? I do not know. What I think is the level of transparency can actually bring a lot of benefits. There are a lot of issues with the lack of transparency, which induce not only operational issues like reconciliation, errors, etc., but it also can also induce fraud. And so maybe a more transparent world can actually bring value to the end users.
Thank you, Matthew. I'm glad to announce that, of course, our first speaker, Wolfram, said, as I said at the beginning, he had technical issues, but we are glad that he can join to us. So I'd like to present to our audience. Wolfram Sidman has been CEO of GSEC and Different Currency Technology since 2017. Since 2021, he has been the CEO of Advanced 52 G+D's incubator for innovating public currency and developing G+D's CBDC solution, Filia. Prior to this, Wolfram held a number of executive management positions since he joined the GSEC plus Devrient in 1999. His background is in electrical engineering and business administration, and he holds a PhD in innovation management from the Technical University of Munich. In 2018, Wolfram was elected chairman of the International Currency Association, ICA, promoting and representing the views of the currency industry. Please, Wolfram, I invite you to share your considerations, your initial considerations, and once more, welcome to this panel.
Thank you, Aristides. Thank you, everyone. It's a great pleasure to be invited as a speaker to this honorable audience. And please accept my apology for coming late on stage. The webinar is about a very important topic. The key question on how can a CBDC design create a momentum in extending the value proposition of the central bank to offer a public currency to the entire population help. And that is the question that we started looking into 6 years ago when new technology came into some momentum, and we started then to reaching out to central banks around the globe to have a intensified dialogue on what are the requirements when it comes to extending the mandate of a central bank into offering a digital format of public currency. And understanding the wide space of potential existing use cases and also future use cases led then to a design of a CBDC solution, retail CBDC solution, which we call Filia, our latest little daughter. And currently we are exploring this concept, which has matured into a ecosystem and into a production grade ready solution. We are exploring that with central bank around the globe. We have done proof of concepts, and we are designing pilot projects, which will be rolled out in the first quarter of next year. We come a bit of a different perception or proposition, since blockchain is an interesting technology that offers certain functionality. However, we realized that the strongest concept to ensure privacy is if data is not collected at all. And so our concept takes a different approach to solve the double spending problem, which blockchain can, of course, do by tracking the history of payments. We have a different concept on how that double spending can be avoided. And that offers a fantastic opportunity for the central bank to operate a platform where the value that is issued by the central bank can be made available to the private sector to build innovative products and services and additional features on top of that platform. So the value is issued by the central bank. The wallet, which hold and transact with those values, are issued by private players like commercial banks or financial service providers or fintechs, allowing them to offer new services and new products and integrating them maybe also into other blockchains that are designed to replicate a business model in the digital space. With that concept, we can reach the two extremes. On one side, we enable person-to-person payment, even in an offline environment, because the value that has been issued by a central bank can be passed on from one digital device to another digital device. And to the other extreme, to offer that such values can be used in automated supply chains and in smart contracts that represent new kinds of business models and allow the central bank to reach new markets where the currency can be used. So we think that this is a fantastic approach, and currently we get a lot of interested feedback. Also, for example, in the latest Global CBDC Challenge, where we have been selected as the most, or the concept that allows for most financial inclusion, which is one of the objectives, of course, that central bank look at, since you want to ensure public interest. And we're happy to share this with you, and then I'm of course happy to answer questions that you may have.
Thank you, Wolfram. So I'd like to make the next question for you, based, of course, in the experience of G+Ts, and as you said about the concern of financial inclusion. One common topic in many central bank reports is offline transactions to allow financial inclusion. On the other hand, many central banks, of course, report to some concerns about the security of a CBDC. Offline transactions are usually supported by security hardware and specific trusted cryptographic keys. About this matter, I'd like to ask you, Wolfram, how to avoid complete degradation of the system security in case of a severe security hardware vulnerability or a private key compromise after the deployment, your deployed solution. I'd like to, if you can make some comment about this question.
Yes, of course. I think any system in the space of digital payment needs to take care of a security roadmap which allows for upgradability throughout the lifetime of the system. And clearly, we also need to look into that aspect. But if you look at the technology to use a smart card as a secure environment, in history there has been already strong concepts being developed that can be constantly updated in order to secure the information that is available on the chip. And the system needs to be designed in a way that in case one entity, one such wallet on chip is attacked, and let's assume that the attacker is capable of getting the information out, then the maximum damage this attacker could have done is to steal the money which is stored in that wallet. So it will not be possible to use such attack to create new values or to issue new currency or to attack the system as such. So I'd rather look at it to compare it with a counterfeiter that is taking a copy of a physical note. So then this counterfeit may circulate for a while until it's detected. And same would happen in the digital space, if theoretically, but there are roadmaps, of course, to ensure that there's very high likelihood that this occurs. If theoretically a device is compromised, this device may be used in an offline transaction up to the point when anyone in that chain of transaction is going online, and then it's flagged that there has been a compromise in one of the devices. So first of all, the likelihood of occurrence is low. The likelihood of detection is high, and the system as such is not compromised. If we compare that to the real world, where also only a few parts per million of counterfeit notes are circulating, we consider this to be an acceptable risk. Since in the digital environment, you have even stronger possibilities to trace or to track then where such a compromised equipment was used.
Thank you, Wolfram. I'd like to know if Matthew or Ricardo would like to make any additional comments about this question.
Happy just to add, so not directly related, but I think it's a good illustration of how the central bank can work in collaboration with the private sector. And it's also a good illustration of what I meant before by composability. So here, for example, we've been working with a partner called IDEMIA, who is providing offline payment solution. And what we've done together is basically we have provided them with a sandbox where we have simulated a central bank issuing a CBDC that did not have any offline payment capabilities in itself. And then IDEMIA has created a new smart contract that was interoperable with their offline payment solution with chips and with the CBDC issued in our sandbox by the simulated central bank. And so basically the central bank, we have created a basic smart contract, and the CBDC in that smart contract could be sent to the new smart contract created by IDEMIA and then spent offline. And at any point in time, it was possible for the users who had this offline CBDC to be able to retrieve it for the initial online CBDC. And so here again, it's an illustration of composability, adding new capabilities to the CBDC that was not designed by the central bank itself, but offered as an improved service by private companies who provide value to the end users and who can have a business model based on this.
Thank you, Matthew. Ricardo, I'd like to change the question. An important no-functional requirement to any central bank digital currency is scalability. The use for retail payments is one of the goals that Central Bank of Brazil has defined for a Brazilian CBDC. And of course, this requirement translates to high level of scalability. PIX, our instant payment system, is an example that centralized technology can handle retail load. But my question is, can distributed ledger technology rise to the challenge?
Yes, great question. So performance continues to be, I suppose, the two Ps, performance and privacy, continue to be the subject of much debate, certainly in the world that we live in, with the central banks as they move closer to pilots outside of their POCs. And for us, performance is a process. And so it's never one and done. It's a continued process. You continue to tune and fine tune. And, you know, performance can be addressed at many different levels. So the infrastructure, the platform, the solution, the application, the operations, it all counts towards performance. And we've seen over the years many different initiatives around very high throughput solutions on DLT. But what I will say is that, you know, not every transaction is created equal. And so we've spent a lot of time looking at, you know, the highest throughput environments, the work that we've done with the DTCC, for example, here in the US, a few years ago, looked to simulate an environment that was built on DLT that would address the throughput requirements of the likes of a clearinghouse, the largest clearinghouse, of course, in the world. And by giving us a set of goals to achieve, and by giving us the adequate runway, we were able to set up an infrastructure and a platform and an application layer that allowed us to achieve the goals that we were looking to achieve. So performance for us is a process. We need the right setting, we need the right environments, we need the right runway in order to get there. I will say, though, that you know, my strong belief is that there's more work to be done, of course. We know that there's latency across different technologies, and not all chains are created equal either. So when we say, is DLT ready for prime time, I think you really need to look at, well, what DLT are you looking at? What are the requirements that you have? What are the goals you're trying to set? What transactions are you looking to settle? You know, we talked a little bit about, you know, real-time settlement or near real-time settlement. That to me seems to be a good goal to achieve, certainly at the exchange or clearinghouse level, moving from T2s down to T1s and really accelerating that kind of that goal. And so, you know, we know that we've achieved very good performance in the classical world. But I've been involved in many projects over time where even using an Oracle database, you can have very poor performance if you don't design the applications and the infrastructure in the right appropriate way. So I'm confident that today, coming into 2022, given the right set of environment, given the right goals and the right runway, that DLT can perform at the appropriate levels that we require for retail. That's my personal view, but happy to kind of share the others as well. Thank you, Aristides.
Thank you, Ricardo. Wolfram and Umberto, do you want to comment this question?
I mean, clearly, for performance, we need to aim for at least 100 transactions per second per million inhabitant. And if you want to offer a performant retail CBDC solution. And here, personally, I see still some struggling using DLT technology, but we believe that the developments and the capabilities of technology will further evolve, where DLT may be up to that level of speed, because I personally believe DLT is a good technology. I think it's more appropriate to design digital business model than digital currency, since in a blockchain you always combine the business model with the payment as such. So I'd rather offer a universal payment instrument that is issued by the central bank that can be used to settle in any of the digital business model that may be implemented in blockchain technology, for example, where the participants agree on atomic settlement of supply and payment. So currently, we think the technology is not the limit, especially if you look at our concept. We're using decentralized databases to ensure that everyone who is using a CBDC can authenticate its genuinity. So you have to have redundancy and availability of uptime of this system, of course. However, since we also provide offline capabilities, and this is true consecutive offline payment, so from person A to B to C to D, and it's up to the central bank to decide after how many transactions you would like to finish that offline chain and you would like to rather see it online again. We think that also the availability issue can be handled with existing technology that's available. But we need to design a CBDC in a way that it caters for tomorrow's security requirements, and it also caters, of course, for tomorrow's performance requirements. And I hope that we see CBDC not only in retail from person to merchant or from person to person, but also from person to machine, or from machine to machine, or within smart contracts, where micropayments will be a core application. Streaming of money may be an interesting application, where we see, of course, additional challenges on the performance of the systems. But maybe here again, that's a case that, like Matthew mentioned, where the private sector comes in and offers additional functionality and additional features, because we believe the central bank should not be in charge of the business model. They should be in charge of the authenticity of the currency. And if a business model offers additional value to users, they may also be interested to pay a fee and respond to that private business model that is built upon the platform that the central bank issued for the digital currency.
I'd like to get said, Wolfgang, about atomic transaction. Other important technological capability for a CBDC is delivery versus payment and payment versus payment. They are advertised benefits for a CBDC. That means that atomic transaction should be possible. Matthew, regarding to that, what are the roadblocks to DVP with existing payment solutions, and how a CBDC could tackle them?
I'm sorry, can you repeat the question?
Sorry, we are talking about the atomic transaction, of course. And of course, many papers from central banks talking about delivery versus payment and payment versus payment. They are advertised benefits for a CBDC. But regarding that, what are the roadblocks to implement DVP, and of course, and to integrate that with existing payment solutions? How they could tackle these challenges?
Thank you. So I think technically there's no real roadblock. There's already many projects, institutional projects have been using instant DVP between financial assets and tokenized currencies. So it works well. I think today it's mostly on existing processes and regulation of the banks. So today, for many financial assets, there's a need to involve a CSD. There's a need to involve multiple stakeholders, and their process and ways of working are built around the T+2 settlements. And so they do not have many motivation to move away from this T+2 settlement. Some even build their business model around it. So I think it's, I mean, I'm a technologist, and from a technology point of view, I don't see many challenges to enable this.
I don't know, Wolfram or Ricardo would like to comment this question.
Go ahead.
Yeah. Oh no, I just wanted to chime in, and also from a technology perspective, I don't see a roadblock. For me, key is again to separate between the issuing of a value and a currency, and to ensure the authenticity of the currency, and the operation of a digital business model. And for sure, the currency should be used in such programmed business cases and allow for instant settlement of the digital business model. And by offering a infrastructure of what we call smart wallets that can be integrated as an API to such programmed business, I think there is no roadblock at all. The contrary, it enables the central bank to reach to that new market that is currently being developed.
Yeah, my view would be the same. That I don't think, in fact, the technology is the enabler for real-time settlement in DVP. So whereas today, this is my view, folks. So whereas today you have payment systems that are completely separate to settlement systems. So think about buying a car or buying a house. You go through a very long kind of process of paperwork and exchange and settlement, etc. And payment is completely divorced of that. At some point there is some reconciliation to make sure that someone has paid, but those things are typically very separate. And so today I think the opportunity is to collapse these two things into one, where you have the payment system and the settlement system together, with digital assets, of course, being key to that opportunity. So, we talk about net new opportunities with DLT and this technology. We've talked about programmability. We've talked about atomic composability. I think the atomic settlement aspect, both in PVP and DVP, is really key, and one of the most interesting opportunities that we're seeing. Some of the projects that we've been working on, including Project Jura, looks at this opportunity in depth, and it's true DVP cross-border, which is then the additional opportunity where you're not only collapsing payment and settlement systems domestically, you're actually enabling a global opportunity to create real-time settlement across these different platforms.
Thank you, Ricardo. Thank you, Matthew. Thank you, Wolfram. Unfortunately, our time is over. I'd like, on behalf of Central Bank of Brazil, to thank you for your participation in our webinar. We have achieved the end of our series of webinars about the digital real, and we will close this section with a few words in Portuguese. Right after those words, the governor of this Banco Central do Brasil, Roberto Campos Neto, will deliver a speech with the closing remarks of the series. Agradecemos aos palestrantes por compartilharem conosco suas percepções.
We thank the participants for sharing with us their perceptions. This series of webinars were very fruitful, and the perspectives of our speakers have helped us to mature the perspective of digital currency, and will continue to help us in the next phases of this initiative. I would like to thank all of the people involved. The professor from the MIT, the moderators of each one of the 7 sessions, and to every speaker who have greatly contributed to enrich our debates. I would now like to give the floor to the governor of Central Bank of Brazil, Mr. Campos Neto. Thank you very much, Aristides. It is my great honor to be here in the closing ceremony of Real Digital.
I believe my speech is supposed to be in Portuguese, so I'll go from there. Eu acho que esse debate é super relevante.
I think this debate is very relevant and very important, and this is yet another step in the work started with the construction of the working group in August of 2020. We've had a keynote speech for the opening ceremony and 7 webinars throughout these 8 months, and each one of our meetings were led by Vice Governor of Central Bank, and we are addressing a topic for the development of the real digital. Was represented by 20 foreign speakers expressing the concerns and expectations of academia, technological industry, financial sector, and international organizations. The discussions were very fruitful. I'm sure they helped to clarify many questions and to settle the foundations on the topic of digital currency issued by central banks. Brazil, along the last decades, has invested to offer cheap, quick and inclusive payment methods. The evolution of our payment systems have been supported on the modernization of our legal framework, on broad accessible use of safe technology, and our focus in offering value to citizens. PIX is the greatest symbol of our evolution in terms of payment structures. With a higher than expected adoption or adherence rate, PIX has facilitated the lives of people and has changed the way small business people and informal workers manage their business, reducing costs for people and for businesses. We hope that, just like PIX, Real Digital can become a part of people's daily lives, and it should be used in conjunction with bank accounts, payment accounts, cards, and cash, and helping us diversify the portfolio of payment methods available to citizens. In order to achieve these goals, the extension of Real Digital must stimulate new business models that increase the efficiency of retail payment systems, should also integrate naturally into digital ecosystems and keep up with the dynamism of the technological evolution of the Brazilian economy. In fact, the initiatives to modernize the means of payment are part of the larger process of digital transformation that our society has been going through.
We observe financial markets recognizing themselves to make better use of the increasing flow of information generated in this process. In this convergence of technology and services, the use of payment information creates relevant potential for innovation in the provision of financial services, both in the provision of new services as well as in the increasing efficiency in the provision of currently available services. The development of the digital real fits into the context of BC hash modernization agenda conducted by the central bank and presents itself as a natural evolution of this agenda. With the digital real, the central bank sees potential of incorporating new technologies such as programmable money and smart contracts into our current settlement system, as well as offering a native form of machine-to-machine settlement for Internet of Things applications. These technologies open up space for new business models that can meet the demands of the population for natively digital means of settlement, as seen in the crypto-active system. The tokenization of assets and the launching of digital assets are a reality. It is up to the regulators to provide a safe environment for entrepreneurs to propose innovations so that a larger base of citizens can take benefit of these technologies without exposure to the uncertainties of an unregulated financial environment. This digital environment allows you to reduce costs through standardization and interoperability, protocol reuse, and composition of financial services. At the same time, it allows a high degree of auditability, traceability, and transparency, ensuring the necessary tools for its regulation. These features can result in new products that reach their target audience faster, are more adequate to people's needs, and traded at lower average values than currently possible. Their potential for increasing the financial inclusion of these technologies when associated with other promoted by this central bank is clear. The availability of digital real seems to be a key element to ensure stability in this environment. This entry would be part of the initiative to regulate digital markets, enabling the central bank to continue to pursue the fulfillment of its mission, which is to ensure the stability of purchasing power of currency, to ensure the sound efficient and competitive financial system, and foster the economic well-being of society. Throughout the webinar series, participants of the roundtables held here discussed the guidelines for the development of digital real and brought several lessons, among which I would like to highlight a few. First, in the opening webinar, we saw the potential of digital real. Our first webinar on the potentials of this digital real, given by Professor Robert Townsend, opened up a broad horizon for applications of bank-issued digital currencies. Crypto activities make up the basis of a new financial system that is formed with services currently used based on stable coins and that have been multiplying in decentralized finance environment. The tools of these environments are promising, and central banks must prepare to incorporate them into their regulatory parameter to foster innovation while preserving financial and monetary stability. The panelists of the first session brought a positive view of the implementation of yet another payment instrument, noting that central banks' successful venture in this field developed over the past decades. They also highlighted important concerns such as people's privacy and potential economic impacts that were discussed in more detail in subsequent panels. The second, which was on citizenship, data security, secrecy, and traceability, in the second roundtable, financial citizenship and guarantee of privacy that were the subject of the discussion. In the panel, it was clear the concern of the speakers with this subject. In a digital transformation environment, Real Digital presents itself as another component of change. Representatives from industry, government, and academia have noted the need to arrive at a regulation on the use of information and artificial intelligence tools that allow the development of better products and services, avoiding potential harmful effects to the population. In the third, on offline operations, the payment mechanisms were discussed when both payer and payees are disconnected from the network. The speakers noted the importance of allowing the population access to means of payment that are independent of the operation of elaborate infrastructures, even with restrictions. Access to universally accepted means of payment that is independent of the actions of third parties were presented as an element of citizenship. Currently, paper money serves this purpose, and as technology advances, other solutions based on digital real may become viable. In the fourth, smart contracts, IoT, and programmable money were the next step, and this was the subject of the fourth webinar. Real Digital seems to be a key element for this solution, and the central bank remains agnostic about its implementation strategy, whether through the evolution of centralized platforms already available, such as PIX, or whether through a platform that will be developed in order to open new paths for innovation. The possibility of inclusion of smart contracts and programmability in our payment system is an important motivation for the Real Digital initiative. Among the issues addressed were the possibility of regulatory framework requirements and supervision mechanisms being embedded in the trading protocols and the need for interoperability among the different digital asset networks. The fourth one, on issuing and handling, dealt with the economic aspects of a digital real and potential impacts on credit industry. One concern that was clear in the debate is the possible reduction in the intermediation of funds through the banking system. This would shift the flow of financial intermediation to other channels, strengthening the trend observed in the past years of capital market participation in assets allocation. The transition between these models is already taking place. The digitization of assets and the associated use of table coins only reinforces this trend. The Real Digital gives the central bank tools to ensure a smooth transition by promoting a safe environment for incumbents and new entrants to interact and foster innovation. Another key point is that the international discussion about payments and international transfers has the potential to bring great gains. The discussion about CBDCs has helped coordinate efforts to standardize international payment systems, and this was the subject of the sixth webinar of the Real Digital series. Despite the advances in testing cross-border payment solutions, it is important to note that this issue is not only technological, it has a strong coordination and international relations component. Furthermore, it is worth noting that CBDCs do not bring the only possible technology solution. Other projects based on instant payments or digital currencies have been considered. Today's webinar on the emission and compatibility with existing arrangements brought a lot of ideas about which we are going to discuss further to better define our path in this project. Throughout this series of webinars and debates and other channels open with the society, it has become clearer and clearer that to add value on top of the solutions already made available by our payment system to the Brazilian population, the Real Digital should be conceived as the basis of a smart payment system platform. This is therefore a long-term initiative that depends on maturity of the agenda of BC Hash, especially in the actions more linked to the digital health, such as PIX and open banks. In the domestic markets, which have begun to show demand for new technology but are still under development, and over the international discussion on the subject, which has made clear the need to weigh potentials and risk for country-specific applications. This way, in order to move forward safely, it is necessary to promote testing. With this in mind, I announced today in partnership with FENASBAC the Lift Challenge Real Digital, a special edition of Lift Lab with a specific focus on testing potential Real Digital use cases. Our target audience is market participants, bringing together a qualified audience of banks, payment institutions, fintechs, and technology companies interested in developing a minimally viable product based on Real Digital. The goal of this challenge is to evaluate Real Digital's use cases as well as its technological feasibility. The focus will be directed to the case of smart payments in online environment that can offer functionality such as delivery versus payment DVP aimed at the settlement of transactions for digital assets, not only in digital environment but also in tokenized, P2P, PVP, focused on exchange payment between the currencies, and the Internet of Things aimed at algorithm or direct machine-to-machine settlement. Of course, not forgetting the issue of decentralized finance. We're talking about requirements of compliance and supervision requirements that are established in a standard, and also solutions where both payer as well as payee are offline will be considered. In addition to the focus on these use cases, the proposed infrastructure will also be evaluated for its potential for interoperability with other payment systems, scalability of the technological solution, accessibility and usability, and privacy of the information employed in the use case, and programmability potentials. conclusion is the Real Digital Initiative is a response to the rapid progress of digital transformation and the society's demand for native means of settlement in a new environment. We have come a long way since the creation of this working group on a digital currency in 2020, and with every step we take, we mature the conditions so that these important efficiency gains can be realized. But this is an evolving process where risks and opportunity must be assessed constantly. We have a long way to go, but we're always open to dialogue, and we are sure that we are going to reach a solution that will benefit the whole society. Finally, I would like to say thank you very much to everyone involved in this journey of learning and building a more modern, efficient, sustainable, and inclusive financial system. Thank you very much. We thank the words delivered by the governor of the central bank, and we invite you all to follow the central bank on our social media so that you can see what is happening in the transformation of the Real Digital. We finish here and we wish everybody a wonderful day and a wonderful week. Thank you very much, everyone.